morning, everybody. Joe Ciaccio here. Happy Monday to everybody. Reminder, got 2 agents as of now. Thought I'd get a much bigger response. Who's taking advantage of that Americo IUL bonus they have. Write 5 apps that give you $500 with Americo IUL. Instant answer, write the application from the client. Get approved right then and there. You write 5 of them, you make $500. So think about that there. Also, Prosperity has a bonus program also. 10% bonus every quarter 1, 2, 3, and 4. So it's something you guys ought to think about. It's on the back office. Look it up. If it's something you really want to do, it's out there for the takings. The carriers are giving money away to promote their products, and they're giving it to you in a form of cash. CASH, free money, just for doing your job and writing their product. Not that you shouldn't write the other ones, but if I was in your shoes and I was out hustling and I'm going to write somebody and I see it's a product just as good, something the client wants, client can be taken care of, I can be taken care of, you bet your Butusi I'll write that care. Okay, let's talk about when you hear cash value, extended term, and a reduced paid up policy. Not all carriers have that on their non-forfeiture part. American Amicable has one. I'm going to go through one I wrote for a client just recently, just to show you the nuts and bolts. First of all, I'm going to kind of explain what the 3 items are, kind of show you what you can do with them, when you should use it, and when you should hesitate yourself from moving forward. Every program that we have that has a whole life chassis, which is all of our simplified issue whole lives, comes with all 3 of these items, yet not all carriers. All of them come with a cash value. Every month a client makes a monthly premium, probably starting in the middle to the latter part of the first year. Part of that premium will go towards the cash value. Excuse me, little sinuses are going on down here in Florida, all this pollen. Cash goes into a cash value account, sits off to the side. As years go on, the cash value grows and grows. Now, the way the cash value works is that money theoretically belongs to the client. Yet that money is left in there to respond to the formula to how they keep the premiums level. If your client wants to borrow money from it, they will be charged an interest rate for borrowing the money, yet on the back end, they're going to be making interest on that money. There's normally a 2% difference. They borrow the money, they're still making money. Normally they're charged 2% interest. So let's sit and say your client has got $1,500 in their cash value account. And they say, I need new tires on my car. Can I borrow the money? Yes, you can. Borrow the $500. Most clients will pay a small amount of that back to get that $500 back up to where there's no unpaid balance. If your client borrows the $500 from the policy, they're going to be charged approximately 2% per month. That's adding on. That's taking away from the face value. If the client does not pay back that $500, the $500 will be deducted from the death benefit when they pass away, plus any interest that is due. They got $1,500 in there. They borrow $500. They pass away. Now they get $500 less of their policy value and whatever interest that was not paid back. Extended term. I'm looking at this policy here. I'm going to kind of tell you it's a $6,000 policy, $43 a month, male, non-smoker, 67 years old. At the end of the 10th year, he can cash this policy out and get $1,628. Number 2, the extended term, he's got 7 years and 296 days. going to stop there. Extended term means the client will make no more monthly payments. The policy will stay in effect. They're going to be using the cash value to make the payments. And he's got 7 years and 296 days of premiums to take care of his face amount. Face amount $6,000. He'll always get the $6,000. If he passes away within that period of time, 7 years, 296 days, whoever his beneficiaries will get that full $6,000. If he outlives that, he lives 8 years, policy is null and void. He had coverage for that period of time, making no payments. Number 3 is a reduced paid up. Client says, I don't want to make any more payments on this policy. What can I do? Well, here are your options. Based on the person's health, based on what they want, based on what they're telling you they're going to do, you've got all these options. You can cash it out, get them $1,628, put them into the extended term, or do them a reduced paid up policy. Their reduced paid up policy will be $2,400 and $2,404. Simplicity, $2,400. They can stop making payments, call up American Amicable or the carrier they have, and say, I want to do a reduced paid up provision in my policy. I don't want to make any more payments. I know it's worth $6,000. I don't want to make no more payments. $2,400. Now the client can tell you, I want to get more insurance, but I really can't afford more insurance. So if the numbers work, depending on how long they've had it for, what the premiums are going to be today, how their health is, you can do either the extended term or you can do the actual reduced paid up premiums. If you do the reduced paid up premiums, they're going to have $2,400 off to the side, and you can use that $40 to buy them more coverage. Now, if it's 10 years gone by, I don't know if it's really going to work out for them beneficially for that same $40. Sometimes people just don't want to spend the money. They said, I want my money. Now listen and say your client is not healthy. Something has gone wrong. They've had something major happen. Stroke, cancer, heart attack. The doctor says, you know, Mr. Client, you got maybe a year, maybe 2 years to live. If you're pushing it, God willing, you may get 4 or 5 years. Okay? So all these thoughts are going through your mind, what the client is saying, what the doctor told the client, what the client heard correctly, and they're telling you the same. You as an insurance agent, you have a fiduciary obligation, first of all, to yourself, to do the right thing. Then when it comes to the client, doing the right thing for them. So the client may sit and tell you, Joe, had this massive stroke. I just can't afford to make these payments anymore. So you can give them these 3 options. You can tell the client, well, what you can do is that we can put you in an extended term policy, get you, let's say this happens in the 5th year for this guy here. In the 5th year, the end of the 5th year, he's going to have 5.5 years of extended term insurance. So the doctor says you've only got 6 months, a year, 2 years to live. Okay? I caution you, you just don't do it to do it. You tell the client, listen, if you want, we can use that same $40 to buy you a guaranteed issue policy. And if something, God forbid, happens to you within the next 5 years, you're going to get this $6,000 plus whatever amount that you can qualify for today. So if the client lives 6 months, they're going to get all their money back plus the $6,000. If they live more than 2 years, if the program you put them with only has a 2-year waiting period, let's say that policy's worth $4,000, $5,000, depending on the age, all the variables, the client can get their original $6, plus they can get more using the $40 that they're presently spending now. You can do the same thing when it comes to the reduced paid up. Client may sit and say, I don't want to take that gamble, Joe. I may live a little bit longer than what that's saying. I don't think I will, based on what the doctor says, but based on my heart and soul and the inner strength I have, I think I will. Yet, I cannot afford the payments no more. I need to use that money to have somebody come to the house to take care of me. I don't know what $40 is going to do to help somebody take care of them, yet I don't know their personal business. When you hear cash value, reduced paid up premiums, and extended term, every carrier that offers this here has it. Right here in living color, okay? It's exactly what they will show on their non-forfeiture paperwork. This guy is 67 years old, immediate issue, $6,000, premiums $43. At the end of the 5th year, he's only going to have $630 of cash value, 5 years, 5.5 years of extended term of the $6,000 with no more payments. Or he can say, I want no more payments. I want a policy paid up for $1,057. I've done a couple of these. The client was very happy. The client wanted to cancel. The client didn't want to make the payments no more. What she was telling me was that she wanted to get more insurance and she couldn't afford more insurance because of her current premium. So what we did with her, we did her a cash out, because that's what she wanted. She wanted the money, okay? And then we started her a brand new policy. I think she ended up spending $5 a month more, yet she got out, I'm going to say about $1,200–1,400. She was in desperate need of that money. So the money is there to use as your client wants. Again, if they borrow money from the cash value and they do not pay it back and they pass away, the part that they borrow will be subtracted from the face amount and any interest that was not paid back. Hope that helps. If you need any more help, one-on-one, give me a call. Make it a great day. We'll talk to you soon. Bye-bye, guys.